Welcome to RCR Wireless News. I'm Martha DeGrasse. Our topic for today is capital markets. I'd like to start by introducing the panelists for today's webinar. David Kalesh is VP of Corporate Marketing at Ruckus Wireless, one of the newest members of the New York Stock Exchange. The company raised $126 million earlier this year in an IPO. Prior to Ruckus, David was with Aruba Networks and Allegro Networks. Carl Showalter is a general partner. Welcome, David. Thank you for joining us.
You bet. Thank you.
Carl Showalter is a general partner at Opus Capital. Prior to founding Opus, Carl was with Juniper Networks and Lightspeed Venture Partners. Welcome, Carl.
Thank you, Martha.
And Richard Valera is a senior analyst at Needham Equity Research. He's been ranked multiple times in the Wall Street Journal's Best on the Street poll and Starmine Analyst Awards in the communications equipment and software categories. Thanks so much for joining us today, Richard.
Thank you, Martha. Glad to be here.
A quick note about RCR Wireless News. Serving since 1981, we keep our subscribers engaged and informed day to day. Please subscribe to our daily newsletter and follow us at rcrwireless.com and on Twitter. Rich, I'd like to take the first question with you. We continue to experience low interest rates. Many of us have thought that would be over by now, but it's not. And I would like to know how it's impacting the companies that you follow.
Well, as you noted, interest rates have been quite low for a couple of years now, and I think the broad impact of that is it tends to encourage investment. When you can only get a few basis points on your cash, you're going to tend to invest it more aggressively. So I think it probably has tended to encourage investment that might not have happened otherwise. I don't think it's been necessary. So from an equity investor standpoint, I think it's generally caused a flow of funds into equities, which probably helps equity prices, and probably tends to make companies more likely to invest their cash rather than to just kind of keep it on their balance sheet. But I wouldn't necessarily pick any specific companies that have benefited uniquely from this.
And Carl, I'm wondering about venture capital investors. Are some of them a little more willing to take a risk on a startup since returns elsewhere are meager?
Well, I think that in terms of the mindset, we always look to the capital markets to make sure there is ultimately a healthy outcome for the companies that we invest in. So we keep an eye on the public markets and make sure there is a market for the private companies that we're funding, as well as there's a strong M&A opportunity. And I would agree that the low interest rates have certainly put an aggressive amount of cash on various balance sheets, which companies have begun to spend, and you're seeing that with an increase in M&A.
Right, and we're going to talk about M&A here in a minute. Now, we are still facing the fiscal cliff, and I think probably a lot of activity is on hold until hopefully that's resolved at the end of the year. Does anybody have any perspective they want to share on that situation? Okay, so let's move on. The outcome of the fiscal cliff is probably going to be higher taxes, and I would like to hear about how that's likely to affect the companies that you follow and work with. Carl, what do you see with the startups? I mean, are most of the companies that you work with not even paying taxes yet, or do you think that the higher corporate tax rates in the future might affect them?
As you say, most of the companies that we work with are from company formation all the way through toward early profitability. The majority of the companies that are private are still not profitable, so they're not really dealing with the taxes directly. But indirectly, you look at higher tax rates that will have an impact on potential companies that could be acquirers and may slow that or may affect that.
Okay, and then Rich, do you see some of the companies that you follow concerned about higher taxes?
I think sure they'd rather have lower taxes than higher taxes. I don't know that they're doing anything especially different. Now, I wouldn't say so much my companies. A number of companies have, though, paid special dividends this year in advance of what they perceive will be higher taxes on dividends. That's kind of a one-time thing, which frankly hasn't really affected my companies, but has been pretty prevalent over the past few weeks and probably will continue through the end of the year.
Okay, so something to watch for in the remainder of the year.
Sure.
Okay, great. And I'd like to take a minute to look at some of the mega mergers that we've seen in the year that's ending, and I think they have impacted the overall environment and the infrastructure companies. The Sprint SoftBank, a lot of people are telling us that that's going to be a positive for wireless infrastructure. New cash coming to Sprint Nextel, and perhaps a more clear roadmap of their network plan. Can you talk about that? David, we haven't heard from you yet, and I know that you work with a lot of enterprise companies and some with carriers as well. So can you talk about that?
About the mega mergers?
Yeah, just the overall environment and how it's changing in light of carriers consolidating.
Sure, yeah, but we're happy that there's a big interest in spectrum and wireless infrastructure in general, and we see that just as a macro trend, just because of the growth of data traffic on these networks, and so it's not really a surprise to us. All these companies come at it from a different vantage point, and we don't think it's by any means over. We think there's a lot more to come in that area, just because there's really a wireless land grab going on, from our opinion, around the world, not just in the U.S. And I think there's going to be marriages of lots of unusual combinations that we'll see going forward. But so we think this is only the beginning so much. But for Sprint, we thought it was good because they needed the cash infusion, and they want to grow their business and have been kind of less competitive in the domestic market than Verizon and AT&T. T-Mobile, not having done their merger, needed to do something, and we're doing business with both those folks, Metro PCS and T-Mobile. So we think there's a good fit there. But yeah, we think this is just the tip of the iceberg as wireless only becomes more important, not less important.
Great. Okay, and let's talk for just a minute about T-Mobile Metro PCS. I think that there's still some uncertainty about whether that deal is actually going to get done. Does anybody have a perspective on that? I think that Sprint is probably less likely to swoop in. We just learned today that they're going to roll up the rest of Clearwire, so maybe that's a positive for T-Mobile Metro PCS. But I'd be interested in knowing if anybody else has an opinion on that deal. Come on, somebody.
Well, I don't see why it wouldn't happen. I mean, we can't predict the future. Nobody can. So it would be irresponsible for us to say, oh, it's going to happen. But there's no reason why it shouldn't. Those carriers. Metro PCS adds some value to T-Mobile where they don't have value, where they can expand their footprint, and Metro PCS has done a good job, and they're smaller. So I think the combination of the two will only help both companies now, to the extent to which that I don't think there's any problem with seeing those companies merge because of their sizes, but I don't see anything stalling that at all.
Awesome. All right. Thank you very much. All right. And then looking ahead, I think that Rich, you said that you saw a pretty strong M&A outlook for 2013. Is that accurate?
Well, I think as I alluded to, it's really particularly for private companies, they all tend to be sort of dual track these days, where they're either going to try to go IPO, and that's been pretty challenging. But so if they can't do that, they're going to go M&A. And as we said, there's a lot of cash on balance sheets and getting very low returns, and that definitely encourages, I think, companies to look for accretive transactions. It's very easy to make a transaction accretive, when your baseline is literally, maybe tens of bips you're getting on your cash. It's very easy to acquire a company, even with a relatively modest level of profitability, and make that accretive to your earnings. So I think that's very conducive to M&A, and we'll, as it has been for the last year, and I think will continue to be in 2013.
Thank you, Rich.
One of the challenges that these carriers have, all of these carriers have, is that the internet, these over-the-top applications that use their networks, take them out of the picture in terms of the revenue that they can get. So yeah. I think what's becoming important to these guys is being able to add value beyond just becoming kind of a pipe player. Even though they're wireless, a lot of the fixed line operators, they want to be more than just a pipe, because that's where the money is. And a lot of these over-the-top applications are getting the subscribers' money, but they're doing it at the expense of Sprint, T-Mobile, and Verizon, who are providing the access. And I think those companies want some of that.
Right. I think you're right. Okay, let's take just a minute to look at some of the Ghetto Deals that have been done. I don't know if we can really call Facebook, Instagram a smaller deal, but it looks to me like there's a trend toward companies acquiring technology rather than developing it in-house. And of Carl, I'm wondering if you can speak a little bit to this trend, and especially to the M&A exits from venture investments, and whether acquiring technology is something that helps some of these startups find a buyer when they're ready.
Yeah, I think that, as has been said, the mobile and wireless space is moving really fast. And when you have a fast-moving space with new technology being introduced, it's very difficult for large incumbent suppliers to fill all the holes. And so if you look at these transactions, if you discount perhaps the first 4 or 5, there are a number of transactions which are under $100 million, which are really fill the holes with relatively modest acquisitions with very good technology. So these are places that the acquirers had to have the technology. So a good example of that is Qualcomm with Design Arts, where Qualcomm really wanted to play in the small cell solution, and Design Arts had a good chip. There's opportunity there. And secondly, I would say that for the larger acquisitions, in many cases that's because the acquirer completely missed the market, and the market grew really, really fast, and they had to pay a premium to get those properties. So a classic example of that, although it's not really necessarily a mobile company per se, Facebook, but certainly Instagram took off on the mobile devices, which made it a very attractive target, and clearly a high price was paid. So I think it's a bit of a tale of two cities here, where in one case you're filling in holes of technology and product for your solutions. In the other case, it's about markets that took off really fast, and the acquirers had to have the property for strategic reasons and paid multiples along those lines.
And I noticed that there are some companies coming into wireless that are not wireless players. Ingram Micro is an example. Do you think we'll see more of that?
Clearly, wireless is becoming more prevalent part of business technology, consumer technology, and so forth. And so there's a lot of companies that traditionally haven't thought of themselves as having to play in the wireless or mobile space, that clearly that's changing for them.
All right, and David, I'd like to know your perspective on this. I think that you deal with companies throughout the ecosystem, all kinds of enterprise customers. So can you talk a little bit about how all kinds of enterprises are starting to really look at wireless as an important part of their strategy?
Absolutely, yeah. I mean, it's anybody who has an iPhone or an iPad could probably understand why that is. We see wireless and Wi-Fi in particular. I mean, not just Wi-Fi, but every kind of wireless communication becoming important for everybody. I mean, if you look at schools and their move to take tests and textbooks to iPads and tablets, I mean, they have to have a reliable wireless connection inside their organization to do that. And so it's not, Wi-Fi and wireless has no longer become just a convenient means of connectivity. It's become kind of an essential way that kids and people want to communicate. And if given the choice, everybody will choose wireless every day and twice on Sundays if the wireless connection is fast and if it's strong. One of the things that we're finding in the marketplace is no matter who you are, no matter whether you're Mandarin Oriental Hotel or your Sprint or your Telefonica, that data demand is growing so fast, and a lot of these networks weren't really designed to handle data. The carriers and the enterprises can't put in infrastructure fast enough to even satisfy the demand, because it's like bandwidth. 5 years ago we would have never even thought about, well, what would I do with 100 megabits to my home? Now I'm spoiled if I don't have it. And wireless has become the new bandwidth. I mean, look at what Sprint did. Sprint's trying to buy Clearwire for $2 billion plus, and the reason that is they just need more capacity.
Right. Okay, thanks. Now, before we leave M&A, Rich, are there any of the companies that you follow that we should be watching as either acquirers or possible targets during the year ahead?
Yeah, I thought we might talk about an upcoming section, but we have a number of sort of themes that we think are kind of interesting for the upcoming year. One is just the general Wi-Fi theme. In that vein, we have Ruckus, which we've talked about with Dave. We also have Aruba, and sort of fitting in with what we were talking about before in terms of how M&A is being used to fill in niches. Aruba was a fairly aggressive acquirer over a couple-year period, buying a number of small companies to fill out some holes they had around really policy management and onboarding of new users. And so they made a number of acquisitions, did a fair amount of internal R&D, and put together this platform called ClearPass, which is now a pretty major product initiative for them. So they're an example of someone who has sort of pieced together a number of acquisitions to create a major piece of new technology that they didn't have before, and I think they could be an example of someone who might continue to do that.
Okay, great, and we will get back to some of those themes in just a few minutes here. So I'd like to move on to venture capital. Carl, this is obviously your area, and I think that we've seen a healthy 2012 so far. These figures are from Rutberg & Company and show almost $4 billion in the first half of 2012, and Rutberg is saying that venture investment is on track to equal about that same amount for the second half of the year. So I'd like to sort of get your opinion on the sectors. Obviously, infrastructure is still big, but within that, telecom is a smaller piece of the pie.
Yeah, so if you look at the telecom, I mean, that is and has and continues to be a challenging investment area for the venture space. And that's primarily because the sales cycles are really long. A lot of venture guys have scar tissue from 10 years ago where there were too many optical companies and too many other infrastructure companies. And that's sort of the dark side. But on the light side, it turns out that for companies such as Ruckus and others that don't have a lot of competition because there aren't as many investors who want to invest in them, they have a fair amount of running room and can go build a large franchise and get public. And that's what we look at is trying to find infrastructure companies that solve a real problem and that can do so in a fairly open space in terms of lack of competition for at least during the formative years. And so the key for that is having a strong investor syndicate to pull the company through the process of long sales cycles with individual carriers themselves.
Now, I wonder about those strong investor syndicates, those patient investors. It seems like a lot of people are focused on the mobile apps and the quick turnaround. Are those two worlds sort of competing for venture dollars?
I think it's a tale of two worlds, and it's important to really divide mobile investment into platforms and applications. And clearly, from our view, all mobile is not created equal. Application companies, in many cases, particularly those aimed at consumers, are hit-driven, and while they're really low cost to get an app into the market, it's hard to predict for those of us who are mere mortals which of these will take off and which ones will be, ultimately great companies. On the infrastructure side, it's a much different story. If you think about a platform that sells to these app companies, it's a little bit, the analogy holds of the general store selling picks and picks and shovels and jeans to the miners of California. If you can be selling to all these different app companies a platform that they can use, that can be a very compelling company and a very compelling opportunity.
Okay, so maybe even different sets of investors that get involved. Okay, and David, can you talk a little bit about Ruckus's history with fundraising? I know that you are a success story, so maybe you can just share your perspective.
Yeah, sure. We're kind of a typical Silicon Valley startup. We started with a couple guys and a good idea, incubated at Sequoia. Sequoia was our the guys that had the faith in the two founders. They actually incubated them in Sequoia, and then when our CEO Selena got involved, we decided we could go after the market. The thing with us is we took a couple of right turns. One of the things that's great about our company is that we're willing to kind of admit where there's markets that we're going after that really aren't going to give us that billion-dollar valuation. We went after the IPTV market with a wireless system, and we were very successful in that market. The problem was the gross margins in that market were really lousy, and it was more like almost like a Netgear consumer type play. So we quickly took that technology and went into the enterprise wireless market in about 2007, and we had great success there. but we were late to that market. However, we went after the part of the market that was really underserved, and that was the middle part of the market. But still, you know, we weren't a leader in either one of those markets per se, and we really felt like we had something unique and different. The thing that kind of carried us through all this was that the stuff we had always built was designed for carriers. So when the iPhone came out and the iPad came out, we really went after the carrier market because we saw the need for, you know, more capacity, and Wi-Fi has come kind of the common theme among all those things. But when we went, you know, to go public, we really view ourselves more as a software company, because as the previous speaker was talking about, you know, it's all about margins and recurring revenue and business models and opportunities for growth. And so we really positioned ourselves as an edge player that could add value in terms of software services at the edge of the telecommunications network, at the edge of the mobile network. And that's where I think the investment community really got interested. You know, when we talked about the wireless LAN market, you know, that's a pretty well-known infrastructure market, but they don't. It's almost passé in their mind. So we've kind of had a long road to getting where we need to get. But even though our IPO was you know, the first day we dropped 18%, so a lot of the stories and people thought we did a lousy job. You know, we did get $1 billion for the company, and since then we've recovered quite a bit. So I think the market when we went public was really looking for us to dump, and we really didn't as much as they thought we should have, and as a result, you know, we've gone back to where we thought we should be at the beginning.
Right, I noticed that. Now, can you talk about how much of your business now is with the carriers versus directly with enterprises?
Yeah, actually, I can't. We don't divulge that publicly, but it's a fair amount. I mean, you can imagine that we've been, you know, talking to carriers since the beginning of our company. So, and we've won a number of major deals with people like the Cloud and BSkyB, and Tower Stream and Singtel and Deutsche Telecom and folks like that. So it represents a fair amount, but that number is only going up and to the right. The thing that's kind of interesting is that the enterprise market, the wireless LAN market, is kind of slow and steady. You know,
okay.
You get kind of a conservative, nice ramp. But the carrier market's very deal driven, and these are big deals. And there's lots of recurring revenue. So when you add the kind of the peaks and valleys of the telecom equipment market with the slow and steady line that you get with the enterprise market, the combination gives you kind of a nice overall trajectory.
Okay, now Carl, are a lot of the companies that you're involved with also selling to carriers and directly to enterprises?
Most of them either bifurcate. They either pick their first beachhead as carriers, or they pick a beachhead as enterprises, and maybe over time they take on the other as they get traction in the first. But because we get involved primarily in company formation in the very early days, we feel it's important to pick one segment to get the product developed and product into market before you spread out too far. And it's just a matter of the timing on which you do that.
Okay, that's very interesting. And when it comes to fundraising, do you find that there's any difference in how easy it is for companies to raise money depending on who their target customer is, or that does not make such a difference?
It's absolutely one of the most critical components of fundraising. Clearly, startups that sell today to enterprises have a much easier time raising money than startups that sell to carriers.
Yeah.
And it takes and the reality, as I mentioned earlier, it's just the challenges of sales cycles and distribution and so forth selling to carriers. But on the other hand, when you're successful and you have a company that is successful selling carriers, the revenue can grow extremely fast as the carriers do adopt the product. And you saw that in the last couple of years with Starent and other companies that really exploded when their carrier business took off and grew very rapidly. And you can also do so with really good gross margins from a product perspective.
Okay, great. So,
we've gotten criticized a lot for having kind of two lines of business, one in the enterprise and one in the carrier. But what we're finding is is there's the line between the line between enterprise wireless and carrier wireless is beginning to blur. It will never completely blur, but if you think about a hotel or a school or a public venue, when you use Wi-Fi, you use it indoors. When people think of wireless, they typically think outdoors using your cell phone. But with Wi-Fi, you use it indoors. So carriers are really, really interested in getting their branded service indoors where their cell coverage can't penetrate. And that means hotels, that means schools, that means and all these different enterprises that have traditionally just been sold to by equipment suppliers. So we see the rise of managed services all over the world where carriers would go and sell a solution to a university or to a hotel or what have you. I mean, obviously there's not one, perfect model, but we see that line blurring, and especially in the middle market where there's lots of users. So if you can position yourself well and have a value-added proposition to both those markets, you can be successful.
Right.
Yeah.
Now, Rich, go ahead.
Yeah, sorry, it's Carl. I would agree 100%. I think that the line is blurring, and you see, particularly in building, the reality is that the demarc between the carrier and the enterprise is getting rapidly blurred as there are more and more employees bringing in smartphones and tablets, which are both Wi-Fi enabled as well as 3G or 4G enabled. That line is going to continue to blur, and that presents an opportunity. I think a strong opportunity for carriers because they're going to be able to provide these managed services and provide a way to get out of sort of the just providing the access and having that be a decreasing revenue stream. If they can provide these additional services that help bridge this blurred line, I think there's a real opportunity there.
Now, ultimately, the carriers are serving the enterprises often, so the companies that supply them may also serve those same enterprises. Do some of these companies find themselves walking a fine line between competing with their customers when they are servicing a company that's also serviced by a carrier?
So this is Carl. I think it's an interesting question, and some of it depends on what kind of wireless protocol you're talking about. Because clearly, on the license side, that's something you have to sell to and through carriers because they own the licensed spectrum. But as you look at things such as Wi-Fi, where enterprise have Wi-Fi systems, carriers can offer Wi-Fi systems, I think it does require some thought on the best way to distribute the product and implement the product and scale the product for the enterprises. And I'm sure that Ruckus has spent a lot of time figuring that out because they've been so successful.
Well, we do see, I mean, it would be stupid for us to say there's not going to be competition. There is. In the enterprise market, we sell through a pretty healthy network of resellers. And those resellers do sell into hotels. They do sell into stadiums and such. But and so from time to time, yes, there will be, some competition. We do see the carriers, they look at it kind of bigger. The carriers want the big accounts. They want, the Starbucks, and they want the, things that have, teeth. And a lot of the regional value-added resellers, they serve companies within their locality, within their region. So we haven't seen that much competition yet. But I think that the key is, I don't think there's going to be, it's not either or, it's okay. A matter of what the customer wants. So sometimes the customer won't trust the carrier to manage their network because it's near and dear to their hearts, and they have a relationship with the local systems integrator. On the other hand, there might be other customers that want that and that want to just get one bill, and they really trust AT&T, and they get an SLA, and that might work well for them. So I think giving the customer choices is really ultimately what's good. And yes, there will be competition, but that's going to be healthy, I think.
All right, great. Now, Rich, this must apply to some of the companies that you cover?
Well, certainly Rich. I cover Ruckus, so clearly it applies to them. It's interesting, some companies that are in a fairly similar space, I mentioned Aruba, they've actually decided not to pursue service provider directly. I think they will do managed services, which we're talking about, sort of a fine line where a carrier might go in and actually implement a network in an enterprise and manage it for them. That's one kind of sale which Aruba will do, but they don't want to sell directly to the enterprises because they feel that will be sort of dilutive to their margins. They have very high gross margins, sort of above 70%. So they've actually made a decision not to pursue carrier, thinking it's a little bit dilutive to their margins. But yeah, I mean, Ruckus is a good example of one that sells to both, and I think manages it quite well. We have another company like Adtran, which has two very distinct sort of carrier and enterprise businesses. It also manages that pretty well.
So I think I would disagree just a little bit. I mean, I know Aruba kind of shied away from some carrier business in China because it was dilutive to their, like you said, dilutive to their margins. But Aruba will go into the carrier market. Absolutely, it's just a matter of time. They might buy their way in. They might, but they have to. And we do see them. I mean, just look at their participation in the WBA Hotspot 2.0 trials. I mean, why would they be in that if they didn't want to go after that business? And we do see them in carrier accounts. The problem is they haven't yet, and I'm not trying to bash them at all, but they haven't yet delivered kind of carrier class technology. They're still going to market, trying to market into the carrier segment with what's largely enterprise developed and conceived technology, and that's a problem in and of itself. We happen to do it opposite. We tried to take carrier technology into the enterprise market with the value proposition of, hey, more reliability and this and that played pretty well in the enterprise space. But yeah, Aruba will go in there. They have to kind of maintain their growth projections, or at least the growth projections that the street wants to see.
All right, before we leave this slide, I'd like Carl to see if you have anything to say about the investment in device startups. I believe that that's something that has not been prevalent for a number of years and is starting to come back just a little bit. Do you see any of that at Opus, or are you focused almost all on infrastructure?
So we don't focus on devices per se. Certainly we've made some investments in components that go into connected devices.
Okay.
But there's definitely been, over the last 2 or 3 years, a fair number of mobile devices getting some funding, particularly around mobile health, so wearable, sensors and so forth. Obviously the Nest thermostat and other kinds of things have gotten some funding. The challenge for these companies really comes down to, from a venture perspective, how do you manage your channel costs, how do you deal with inventory, and how do you spend enough money to create a large consumer brand? Because most of these products are targeted toward end consumers. And so, when you think about the companies in the venture-backed space, they generally like to get to market on less than 30, 40, 50 million, or even in an extreme case 100 million. Whereas if you look at large brand companies, they easily spend hundreds of millions on brand advertising every year. So in many respects, those lines don't quite make sense from a venture perspective.
Okay, that's good. Yeah. So we'll see what happens there. Now, we had talked before about the mix in investment, and I think it's interesting to see, well, first of all, to see how venture investment is sort of coming back. I think that it has dipped, and again, when we spoke with Rutberg, they said that they believe that 2012 will end up equaling or probably surpassing 2011. So I think that that'll be good to see. And the carrier piece is obviously getting smaller and smaller, while the technology piece is getting bigger. So I just wonder if you have anything, to say about whether you think that, if we look at this graph 3 or 4 years from now, would it be all red, or do you think that we'll always see that little bit of yellow, or are there any perspectives on that you want to share?
Sure, absolutely. There will continue to be some yellow. And I actually think the fact that the yellow is smaller means that those companies have a better chance of being successful, because they won't necessarily have 5 or 6 competitive companies trying to sell to the same carriers.
Okay.
You saw that with the success of Ruckus. There are other private companies like Spider Cloud who really don't find direct competitors in the market, and as a result are able to really get their technology into the carrier's hand. But if you look at the red piece, that is a combination, I think, of software, of apps. Mobile's pretty broad these days, and it's clear that I think we're still in the early days of mobile investing. I think it's going to continue to increase. It's obviously there's fluctuations quarter over quarter, but you're going to see a tremendous amount of increased investment in mobile just because it's becoming such a more prevalent part of consumers' lives, but also, as was mentioned earlier, the business world, where people are expecting that their tablets and their smartphones work in their enterprise and work as though the same as their PCs worked previously.
Yeah, I think that we see mobile as a bigger and bigger piece of the overall venture capital that's out there. And you did mention apps, and I thought that we should talk for just a minute about the apps that are targeted right at the enterprise. I wanted to see if any of you have worked with companies that are sort of making this part of the offering to an enterprise. I know that sometimes software as a service makes the infrastructure sell a little bit more compelling.
Yes, absolutely. We have, for sure, in the area of location and mobile device management. If you think about a hotel, for example, a large hotel chain, the Marriott's, they have a large-scale infrastructure, and what investors don't want is a company they have to invest in that has to sell one time and then walk away. Okay, here's your wireless LAN. We've installed it. Have a nice day. We'll never see you again. And that infrastructure can be leveraged. It can be leveraged by that hotel to offer new kinds of service, to optimize their existing services, to give guests different kinds of services, and can be offered to wholesale capacity to carriers that want to get capacity in that hotel, for example. And so we're looking at ways to add software value in software on top of that infrastructure, both in the carrier market and the enterprise market, to be able to do things like location, to be able to offer a hotel chain the ability to give a mobile app, or to allow a mobile application to be automatically downloaded to a guest. And once you have that, you can request bellroom service, you can get restaurant reservations, you can pay to get theater tickets, you can do all kinds of different things. Now, someone's got to write those applications, but if as infrastructure guys, we're ideally suited to provide the location hooks to those application developers. So yeah, we're starting to see much more interest, at least on our end and our customers' end, from, okay, I've got now a really rock solid Wi-Fi infrastructure. How can I leverage it, not only to the benefit of my company and being able to optimize the services I deliver, but also to maybe even make some money?
Rich, are any of the companies that you follow seeing that?
Tough to say at this point. I don't think we have any that would really quite fit that.
Okay. All right. And Carl, do you have anything further to say about the enterprise apps?
No, nothing specific. I think that every enterprise software company is focused on how they provide access to their applications on tablets and smartphones, because that's what users are expecting, given that that's what we've trained them to do on the consumer side.
Right. Okay. All right. Well, let's move on to the IPOs. David, this is obviously your area. You've just been through this. I know that you were courted by the NASDAQ and the NYSE. Do you want to just talk about the experience a little bit?
Well, that experience was crazy. Yeah, it's funny. Most folks consider tech companies just to go right to NASDAQ. Historically, they have, but there's been a lot of changes. When I was at Alteon years ago, when we went public, it was just a foregone conclusion we'd go on the NASDAQ, and now it's all changed. And so they really compete for your business, these two exchanges. And when push came to shove, and we looked at all the things that, everything was pretty much the same except for the marketing that they would provide you, and they give you all kinds of marketing incentives to come and list. So it actually became a marketing decision which exchange we would go on. But our IPO it took a long time, even though it kind of crept up on people. It took us quite a bit of time. We did a lot of auditing of our books to make sure that we had our house in order, and nowadays going public, it's just much more difficult. It's much more rigorous. You get scrutinized on every part of your business, and there's so much time you have to take and invest to get an IPO that will stand the test of time. And even though we went out and yeah, we went down 18% in our first day, it really doesn't make any difference. All that matters is if you can add value and continue to perform and deliver to your investors what you promised them, and to live up to being able to deliver that improved growth. And that's we're kind of focused on that. But we wanted to make sure that we IPO'd with no debt, and a decent and strong and cash flow, a good vision of where our money was going to come from in the future, and a story that was really differentiated, because that's what investors like. And I think the jury's kind of still out on how we'll do, and I think there's kind of a wait-and-see attitude. You know, the next couple quarters is going to be quite telling in terms of where we end up as far as our valuation goes. But we're pretty happy with what we got. The only thing that kind of surprised us was the timing and the size of the Cisco purchase of Meraki for $1.2 billion. That kind of, we knew they were working on that, but we had no idea that they would ever pay that amount of money for a company that was, you know, doing 17 to $20 million a quarter with no profits. But we understand why they did it.
Okay. Now, Rich, I know that Needham was one of the underwriters for the Ruckus IPO. What do investment banks look for? Anything you'd like to add to what David already highlighted?
Well, I think generally what, you know, we focus on, you know, technology growth companies, and what tech growth investors are looking for are, as David said a couple times, you know, competitive differentiation and I think secular growth themes, you know, things where we look down 5 years from now, where do we think this trend is going to be? And I think, you know, carrier Wi-Fi is one where virtually everyone agrees that over time carriers are probably going to use Wi-Fi in a bigger way to augment their cellular networks, which are going to essentially run out of capacity for the sort of data tsunami they're facing with, you know, with iPads and smartphones. So that's sort of a secular theme, you know, the growth of both enterprise Wi-Fi, which I think is being driven by, you know, people bringing iPads to work and enterprises adopting things like iPads, and then carrier Wi-Fi, which is perhaps an even more, you know, unique niche for Ruckus. They have a much more, you know, sort of dominant position there, perhaps. And you know, and when we think of very long-term growth, you know, type of story. So it's really, you know, growth, and particularly secular growth, and hopefully differentiated technology. And I think if you have all those things, and then of course, you know, you can execute on it and actually put up the numbers that people expect you to put up, you can do very good as an IPO. Now, the flip side is if you go public and you don't deliver, and there's plenty of stories like that. If you miss, you know, your first quarter or two out of the gate, you can be put in a penalty box that can literally last, you know, years. So, you know, there's risks involved, you know, in going public, but if you can execute, you know, it can be a good thing for the company, gives it a lot more access to capital and a lot more flexibility in how it goes forward.
And how would you characterize the pipeline for 2013? Do you think we'll see more or less wireless and mobile IPOs than we saw in 2012?
Well, I mean, the challenging thing is, you know, this sort of speaks to the whole conversation we've been having on the particularly carrier infrastructure. They're pretty few and far between. You know, there's just not that many companies that are reaching scale. It's very difficult to build a carrier infrastructure company because of the very long sales cycles and gestation periods. So there's not a ton of them. You know, that's why it's exciting to see something like a Ruckus get out, because, you know, they're one of a relatively select group of companies that have managed to tackle that space. So, you know, I think there are things out there. There's a company, Mavenir Systems, which is on the infrastructure side, but really more on the software for enabling voice over LTE and advanced services over LTE networks. That's a very interesting area, which we'll talk about in sort of an upcoming segment. But you know, they might have a shot, but there's not a ton. You know, it's a fairly select group of companies, I think, that are in the sort of carrier infrastructure space that are likely to be able to go public.
Okay, great. Well, let's move on to some of those themes that you've identified. Well, let's start with Wi-Fi. Obviously, we've talked about that a little bit already, but a theme for investors and touches some of the companies that you follow. Do you think that this is something that investors are going to continue to focus on in the year ahead? Do you think that there are other companies coming along that might be Wi-Fi plays?
Yeah, I mean, clearly, I think investors, you know, Wi-Fi has gotten investors' attention between, you know, as David said, Cisco paying $1.2 billion for a company doing under $100 million of sales, and then, you know, Ruckus going public and getting a nice valuation, you know, for where they are. I think people are realizing, you know, that Wi-Fi has, you know, some growth potential, and it's a very interesting area. You know, I'm not sure that there'll be necessarily other IPOs following quickly behind, you know, but I think in you know, the companies that have gotten public, I think will get plenty of attention. I think Ruckus and Aruba will continue to be at the forefront of growth, infrastructure investors' minds. So yeah, I think that's, maybe not a lot of, similar IPOs, but certainly plenty of interest in those companies that are public.
That are already out there.
Yeah.
And do you want to talk about a little bit about investing in small cells?
Sure, and I'm sure David will be happy to pipe in as well. But if anyone who goes to Mobile World Congress or just pays attention to what comes out of that, I'd say for really the last 2 years, but particularly this last year, one of the biggest themes coming out of it was small cells and het nets, which basically are basically saying things carriers are going to have to do to increase the coverage and capacity of their network outside of the traditional cellular macro station architecture. So small cells are basically using licensed, cellular technology, but doing obviously much smaller cells as kind of an underlay to the base station, to the macro, level. And then you can also use, of course, Wi-Fi, which we've talked about that Ruckus does quite well. I think small cells on the cellular side have been pretty slow to take off. They're, as we sort of talked about before this, because of the licensing, the interference, the integration with the core, they're trickier than deploying Wi-Fi, which is unlicensed and relatively straightforward to backhaul, for instance. But I do think there's a real market there. And that, if you talk to almost any of the big carriers and listen to what they're saying, they all say small cells are an integral part of their ultimate network sort of coverage and density plans. So we have a few names that some that we cover, some that we don't, that play in this space. Ruckus, and I'll let Dave talk about that, but they have a product that lets you combine a Wi-Fi access point with a femto or a picocell in the same physical device, and that could be, proved to be quite interesting. And then there's companies like Radisys, which actually do the software protocol stacks that are in many of the picocell designs out there, again, many of which are just in the very early stages of ramping. And then Mindspeed, which is a company covered by another analyst at Needham that makes chips that go into lots of picocells and some femtocells. So that's I think small cells is an interesting theme, still very early, but I think has some longer-term legs to it.
Okay, well, we've got about 3 minutes left. David, do you want to take a minute to tell us about what Ruckus has going on in small cells?
Well, everything that Rich said was we couldn't agree more. Right now, we think it's more hype than reality. All the carriers, yeah, they're almost by definition needing to go to smaller coverage areas and to augment their macro networks with both Wi-Fi and smaller cellular coverage. But doing that is quite a chore. It's not as easily said than done, and Wi-Fi is going to be the first step by which they do that. We've done some work with Telefonica in the UK where they've put our box all over Trafalgar Square, Piccadilly Circus, those kinds of places, and it's just Wi-Fi to start. And they want to kind of see how things play out before they start to add the small cell module. And it might be ours, it might be somebody else's, but they want that one device to be able to put as much technology and electronics in that device as they can to leverage that. But right now, it's a lot more talk than it is action. But all the big guys, the Ericssons, the Nokias, and all the carriers, they want to future-proof their networks because there's only one chance to get on that pole. And having to pull fiber to that pole or having to get somebody on that pole to swap it out is a big charge for these guys. Because small cells, by definition, means a lot more than, like 10 macros, base stations. Yeah.
All right, thanks. So, Rich, back to you. Do you want to talk briefly about the companies you follow that are going to be active in voice over LTE?
Sure. So that's another hot sort of investor topic in, I'd call it the wireless infrastructure space. And, voice over LTE is important to carriers for a couple of reasons. One, ultimately, they'd like to, as quickly as possible, they'd love to decommission their 2G and 3G spectrum and move everything to 4G because you get roughly 50% better spectral efficiency out of LTE than you do with 3G technology. So clearly, if you can get more capacity out of the same spectrum, you're better off. So they want to move to voice over to LTE, which, right now it's all on 3G because LTE doesn't sort of come out of the box with a voice capability as 3G did. So they've got to basically build voice over LTE into their networks, there's a few things that have to be done, but you do need you need an application essentially that runs on top of the LTE network, and it's going to ultimately be a lot more than voice. I mean, they want to be coming up with a lot of these value-added services that right now are being done over the top, but they're going to want to have a sophisticated array of services, including voice, over their LTE network. So very important initiative for the carriers to, one, enable them to sort of increase the spectral efficiency of their networks by shifting stuff to 4G, and two, coming up with services that can cause them to sort of fight back against all these over-the-top carriers that are trying to take away their customers and turn them into a dumb pipe. So both Acme and Broadsoft, which we cover, play in that space in different capacities.
Absolutely.
Okay, great. Now, Carl, do you have anything on any of these themes with any of the startups that you're working with?
Certainly, the two areas. One is Wi-Fi, and more broadly, sort of connecting Internet of Things. So more and more of the devices and endpoints in the home, in the office, on people themselves. There's a tremendous amount of designs that are happening now that have Wi-Fi in them as an endpoint. Everything from personal health devices to thermostats to appliances and so forth. So that's really accelerated over the last 12 months. So that's definitely an area of interest for us. And then on the small cell side, clearly, a number of interesting companies in that space, be it outdoor, as Ruckus talked about, or indoor, as companies such as Spider Cloud and others. So there's definitely a move toward that, and I think we're sort of moving through the hype curve to, over the next year or so, start to see some real substantial deployments happening in those spaces.
Okay, thank you very much. We are out of time, and I want to thank all of you for joining us. David Kalesh from Ruckus Wireless, Carl Showalter, Opus Capital Ventures, and Richard Valera, Needham & Company. Thank you all very much for joining us today on RCR Wireless News. This webinar will be available for download at rcrwireless.com. Thank you.
Thanks, Mark.
Thank you, Mark.
Thank you very much. Bye.
The organizer has ended the session, and this call will be disconnected. Goodbye.